One thing I didn't expect when the business started producing real income was how uncomfortable larger financial decisions would feel. When the numbers are small, decisions feel simple. You spend a few $100s on software, maybe a few thousand on marketing. If it works, great. If it doesn't, the business survives. Those decisions rarely feel emotionally heavy. But something changes once the scale of the business grows. Suddenly, the decisions aren't hundreds of dollars anymore. They're 5,000, 10,000, sometimes much more. And the strange part is that the business might be fully capable of absorbing those decisions, yet writing the check still feels uncomfortable. I started noticing this the first time a decision crossed into a range that previously would have felt impossible. The math said the business could handle it. The opportunity looked logical, but emotionally it felt completely different from the smaller decisions that came before. The bigger the check, the louder the psychology becomes. It took me a while to realize that the discomfort wasn't really about the money itself. When you're building something from zero, your instincts are shaped by scarcity. Every dollar matters. Every decision carries risk because the system is fragile. Those instincts keep the business alive early on. But the strange part is they don't disappear just because the business grows. They stay inside your decision-making long after the system has become stronger. So when the first truly large investment opportunity appears, your brain reacts as if the business is still fragile, even if the numbers say otherwise. I've watched founders hesitate for weeks over decisions the business could comfortably support. Not because the math was wrong, because psychologically the decision represented a new level of responsibility. Writing bigger checks forces you to confront how much you actually trust your system. That's the hidden shift that begins happening once a business stabilizes. Earlier in the journey, the job is survival. The goal is to generate income consistently enough that the machine keeps moving. Later, the job becomes allocation. Now the system is producing capital, and the founder has to decide where that capital should go. The strange part is that making larger investments isn't just a financial skill. It's a psychological one. For a long time, I found myself evaluating opportunities in a very cautious way. Not irrationally cautious, but cautious enough that it slowed decisions. Every larger investment felt like a leap instead of a calculated step. Eventually, I started noticing something interesting when I looked at founders operating at much larger scales. They weren't fearless with money. They simply had a different relationship with risk. Instead of asking, "What if this money disappears?" they asked a different question. What happens if the system grows because of this? That shift in framing changes everything. Because once a business produces stable income, many investments are no longer existential risks. They're strategic bets. And strategic bets are how systems evolve. Growth eventually requires decisions that feel bigger than your past experience. That's unavoidable. The first time you hire someone expensive. The first time you acquire a system. The first time you invest capital that would have terrified you a few years earlier. Those moments feel uncomfortable precisely because they represent a shift in scale. The business you're operating now isn't the fragile machine you started with. But your instincts haven't fully caught up yet. Another thing I began noticing is that the size of the decision often reveals something about the future direction of the business. Small decisions maintain the current system. Large decisions tend to reshape it. Hiring a key operator might change how the entire company runs. Investing in distribution might double the reach of the business. Acquiring a capability might unlock growth that previously felt impossible. So larger checks don't just move money. They move the structure of the system itself. That realization helped me think about these decisions differently. Instead of seeing them as big expenses, I started asking a more useful question. What kind of system does this decision create 6 months from now? Sometimes the answer is obvious. Sometimes it isn't. But framing decisions that way shifts attention away from the fear of spending and toward the potential of strengthening the machine. Because the goal isn't simply to spend money. The goal is to make the system more capable than it was before. I also started noticing a pattern when founders avoided those larger decisions for too long. The business would keep producing income, but the structure of the system would stay exactly the same. Same bottlenecks, same constraints, same growth ceiling. Eventually, it became clear that hesitation itself can become a limitation. The system can only grow as fast as the founder's willingness to deploy capital. That doesn't mean writing big checks recklessly. It means learning to evaluate them properly, understanding what strengthens the system and what simply creates activity. Because once a business reaches a certain stage, progress rarely comes from working harder. It comes from allocating capital more intelligently. And that means accepting that the decisions will keep getting bigger. The numbers will change. The scale will change. And the checks that once felt impossible will eventually feel normal. Not because the money became meaningless, but because the system behind it became stronger. That's one of the quieter transitions in entrepreneurship. The founder, who once worried about every dollar, eventually learns to treat capital as something different. Not just money leaving the business, but a tool used to shape what the system becomes next.